Shalby Q1FY24 earnings conference call hosted by Elara Securities India Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Bino Pattiparambal from Elara Securities India Private Limited. Thank you, and over to you.
Thank you. Good afternoon to all of you, and again welcome to the Shalby Limited Q1 FY24 earnings call hosted by Elara Securities. Today we have with us senior management representatives from Shalby. We will start with opening remarks from Mr. Shashank Dasgupta, Vice Chairman and Global President, and Mr. Parag Agarwal, Chief Business Officer. It will be followed by a discussion on financial performance by Mr. Amit Pathak, Chief Financial Officer. After that, we will open the floor for Q&A for all participants. I will now hand over to Mr. Puneet Maheshwari for important disclaimers before the call. Over to you, Puneet.
Thanks, Meenu. Good evening, everyone. Our earnings presentation is uploaded on the stock exchange website and our company website, shalby.org. We do hope you have already had the opportunity to go through the presentation. Please note that some of the statements made in today's call may be forward-looking in nature and may involve risk and uncertainties. Kindly refer to slide number 36 of the investor presentation for a detailed manner. Now, I would like to hand over the call to Mr. Shashank Dasgupta, Vice Chairman and Global President, for his opening remarks. Thank you, and over to you, sir.
Thank you, Puneet, and good evening, everyone. I'm pleased to welcome you all to Shalby Limited's first quarter 2024 earnings call. At the outset, the first quarter of this year was a robust quarter for our overall Shalby group. This quarter reflected our best hospital business performance in any quarter so far since the inception of Shalby, across most financial and operating parameters, recording significant growth year-on-year and quarter-on-quarter. Our hospital business continued to grow at high double digits in the key matrices of inpatient counts and surgery counts, growing by 24% and 14% respectively year-on-year. I'm also pleased to report that our hospital occupancy levels, which has been a major focus area for us since some months, have improved by 12% year-on-year and 8% quarter-on-quarter to 626 beds and have reached to 50% occupancy rate in quarter one of this full year 2024. These results truly reflect our conscious efforts to improve occupancy levels across all our hospitals through various business development activities. We firmly believe that these initiatives will continue to ramp up our occupancy levels in the coming quarters too. Our core specialty, arthroplasty, has performed stupendously in quarter one, and we are proud to say that Shalby has achieved a landmark of 150,000 joint replacement surgeries since its inception in the last quarter. And with this, we continue to maintain our significant leadership position in global volumes in the arthroplasty segment. At Shalby, we remain focused to demonstrate clinical excellence by performing critical surgeries across many of our units. Few of them I can cite here are the removal of a tumor attached to a heart valve with complete conservation of the valve at Shalby Indore, implantation of a Micra AV leadless pacemaker, which is the world's smallest pacemaker and does not have any wire, in a patient who had previously previously implanted pacemaker had an infection, and microvascular decompression of trigeminal nerve performed with minimally invasive approach. So small in numbers, we are proud to inform that we have performed more than 250 kidney and liver transplants at SG and Indore units so far. We are awaiting to receive hand and heart transplant licenses at our SG unit and kidney transplant license at our Naroda unit. Our home care business services have demonstrated some excellent performance again in quarter one, growing by 70% year-on-year and 30% quarter-on-quarter to revenues of rupees 3.6 crores and patient count of 7,700 that grew by 30% year-on-year basis. Additionally, revenue from our international business clocked rupees 2.5 crores in Q1, growing by 3% year-on-year. As a part of our social commitment, we continue to spread awareness about the importance of health and well-being through various social media platforms and created 95 plus videos during last quarter, and also created 14 additional long and short healthcare video contents in partnership with Google through its arm YouTube. We also conducted more than 230 healthcare camps and 80 healthcare talks across all our units during the last quarter as a part of our various community outreach programs. Our organization also takes pride in nurturing young talent through our Shalby Academy with 290 plus students registered in the various healthcare programs during the first quarter of full year 2024. Our knee and hip implant manufacturing business under Shalby Advanced Technologies in California, US, had a slightly softer performance than planned during the first quarter of full year 24. We recorded revenues of INR 16.5 crores versus INR 21 crores in Q4 of full year 23, mainly due to lower patient flow into elective surgeries in the US, delay in full commercial launch of our uni-compartmental knees across the US due to some delays in instruments manufacturing, and an unanticipated delay in our full commercial launch of our new Ambition brand knee in India. The contribution in sales mix last quarter from US and India accounted for 70% and 30% respectively. We are expected to receive the full instrumentation of Tux next month. That would enable us to go for a full commercial launch. We also have recently received the bulk order from our distributor in Indonesia, and supplies are expected to happen next month. We are also exploring opportunities in Malaysia and will soon be receiving registration approvals to launch our SAP products in Latin American countries like Argentina and Paraguay in the coming quarters. We are also hiring new people in key areas in SAP, such as sales and engineering, that would be direct contributors to our growth roadmap, as well as continuously work on improving operational efficiencies in an incremental manner, and hence substantially bring down our procurement and day-to-day operational costs so that we can return this company to a mid-single-digit EBITDA contributor by the end of this year for SAT. With all these key strategies, ruthless and flawless execution will be the key to our success, having the right people and leadership in place. All this, in turn, will help create continued sustainable value for all stakeholders at Shalby Limited. Now I'll hand it over to Parag to discuss our SOCE quarterly performance. Parag, over to you.
Thank you so much, Sushovan, for sharing quarterly developments on hospital and the implant business. Hospitals definitely have done, far better. A very good evening, everyone. Let me share the Q1FY24 performance for SOC franchisee vertical. As you all know, we now have 4 fully operationalized units at Ahmedabad, Udaipur, Lucknow, and Gwalior. This has a total bed capacity of more than 130 under the vertical. We have performed a total of 154 surgeries in this quarter, which is a growth of 44% quarter-on-quarter and 38% year-on-year. Total revenue from operated and managed SOC units has also grown by 31% quarter-on-quarter and 40% year-on-year. I'm pleased to inform that Shalby has signed an agreement with Divine Super Specialty Hospital, Ranchi, Jharkhand, to operate a franchisee-owned Shalby managed hospital in that region. The hospital will have a capacity of 60 beds, which can further be expanded to 100 beds. The unit will be operationalized from next month under the brand. So around first week of August is where we plan to operationalize and have our brand giving services in the city. We have been very diligent in choosing our prospective partners from various inquiries which we receive from time to time, and what we reach out in different cities. We are very particular in preserving our integrity of the brand and adhere to a well-defined protocol in terms of infrastructure, services, quality, while making these selections for our partners. Looking ahead, we are very optimistic about positive developments in the upcoming quarters in this fiscal year. So far as adding new units is concerned, our primary focus remains on leveraging our expertise and excellence in orthopedics aiming to establish over 50 franchisee hospitals across the country within the next 3 to 4 years. Now I would like to hand over to Mr. Amit, CFO, to discuss Shalby's quarterly financial performance in more detail.
Thank you, Parag. Good evening, everyone. I will walk you through the financial performance of your company for the first quarter of FY 2024. First, I will run you through the consolidated performance of the group. Highest ever consolidated revenue of rupees 240 crores grew by 15% on quarter-on-quarter basis and 17% on YOY basis. EBITDA of rupees 48 crores with the margin of 20% in Q1 FY24 and grew by 37% quarter-on-quarter and 8% on YOY basis. PBT of rupees 33 crores with a margin of 13.7% in Q1 24 and grew by 72% on quarter-on-quarter and 8% on YOY basis. PAT of rupees 21 crores grew by 50% quarter-on-quarter and 4% on YOY basis. The group continued to maintain a very strong balance sheet with a low gearing ratio of 0.11x and closed the quarter with a net cash balance of rupees 81 crores at group level. Now I will be running you through the standalone performance of the business. Operational side, the total surgery count grew by 25% quarter-on-quarter and 14% YOY basis to 8183, with the inpatient and outpatient count improved by 11% and 6% quarter-on-quarter and 24 and 7% YOY in Q1 FY24. ARPOB and ALOS has also shown an excellent improvement at rupees 38,000 and 3.97 respectively in Q1 FY24 versus rupees 34,865 and 4.01 in the previous quarter and 35,304 and 4.08 in the same period of the previous year. The payer mix has largely remained the same on YOY basis and quarter-on-quarter basis. Highest ever standalone revenue of rupees 216 crores grew by 18% quarter-on-quarter and 20% YOY basis. EBITDA of rupees 50 crores with a margin of 23% in Q1 FY24 and grew by 36% quarter-on-quarter and 16% YOY basis. PBT of rupees 40 crores with a margin of 19% in Q1 FY24 and grew by 51% quarter-on-quarter and 22% YOY basis. PAT of rupees 26 crores grew by 43% on quarter-on-quarter and 22% YOY basis. At standalone level, again a very strong balance sheet with a low gearing ratio of 0.02x and closed the quarter with a net cash balance of rupees 156 crores. Standalone ROC has improved to 20% in Q1 FY24. Our implant business has shown a slightly soft performance during the first quarter of FY24 with the revenue of INR 16.5 crores versus INR 26.2 crores in Q1 FY23 and EBITDA loss of 0.35 crores versus EBITDA profit of 0.43 crores in Q1 FY23. Now I can open the platform for any questions we can take over this.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Divya Daga from Vijit Global Securities Private Limited. Please go ahead.
Hello, sir. I have few questions, and first question is, this quarter has been soft for implant. Any specific reasons? As we were expecting a higher revenue from that side.
Thank you, Dibba, for the question. This is Sushovan. So, first of all, if you see the way we have structured the implant business, according to plan, our usual quarters are usually at 25 to make it 100. But we anticipated that this quarter will be soft, and that's the reason this month our plan was around 10% of the full year. So if you see our full year is at $18 million, so we plan to grow about 50% plus over what we grew last year. So our plan was around 10% of the total amount that we had predicted going forward. So the reason that we had said was basically when we looked at the quarter, we received informal insights from colleagues and competitors in our U.S. industry that the last quarter there was a reduction in number of elective surgery days in the U.S. versus if you compare to the same quarter of the previous year. This was due to the fact that many key surgeons availed of the vacation time this year last quarter, which they couldn't take the time last year because of backlog overflowing from earlier COVID situation, especially in the U.S. Our internal data with some of our key surgeons also corroborated the same theory as we took it from other industry friends that I have in the U.S. The other factor which played was that we did some changes in design of our new unicompartmental knee called TUX in the instrument side and redesigned them to make them much more simple and efficient as per the guidance and advice from our designer surgeon, Dr. Richard Reitman. Unfortunately, this process of design change went through numerous iterations that took up much more time than anticipated before arriving at the final design, which in turn delayed the manufacturing and delivery of these redesigned instrument sets for TUX from our supplier partner. Hence, the full commercial launch for TUX in the US got delayed by a quarter, and now these are expected to be ready by end July and early August. So we expect our TUX commercial sales, especially in the US, to pick up from August onwards. Also, there were some orders from Argentina and Paraguay, which were delayed. We thought it would be coming this quarter. It did not happen because has been some delay in getting regulatory approval from the countries. In India, if you look at our market, our knee market, especially for Shalby, it's around 85 to 90% of the total organized implant market is knees. We had anticipated the launch of our latest new design knee branded Ambition in the last quarter. Unfortunately, the design and development of the specialized instruments needed specifically to implant the Ambition knee into patients got delayed by some months by the manufacturer, and because we were converting this from a disposable instrument to a reusable instrument design. And hence, this pushed back our Ambition knee launch in the coming months. Just to give you some information on this new knee, this is the latest design Ambition knee that's already been approved, FDA approved in the US, and this is a posterior stabilized knee, which is mainly used in countries like India, where the PS knee is almost 75% to 80% of the total knee market, versus a cruciate retaining knee, which is CR knee, which is more used in the US. So this PS designed Ambition knee is expected to be a big game changer for our India and Southeast market, which is predominantly, as I said, a PS knee market. Due to this unexpected delay in supply of the mandatory instruments required to implant a new Ambition knee, we saw this soft performance in our business in India, and we couldn't also launch the same in Indonesia as planned earlier. Some good news, Divya, to let you know, is that our vendors have completed the drawing of these instruments for Ambition, and they have gone now into the manufacturing phase. And since we're confident that we'll be able to launch this blockbuster knee, especially in India in a few months from now. Our outlook remains positive for the coming quarters, both for US and for India and the OUS business. And with the series of blockbuster new product launches, which I'll talk later on, line towards the back end of the year, we'll see a much more heavier third and fourth quarter. And then we'll be getting into new markets. Surgery volumes definitely will be getting into normal, which we see already in the US. And we'll win back some lost customers in the US. We are very much in line to achieve the 50% top line growth for Shalby Advanced Technologies for the full year 2024. Hope, Divya, it was a long answer, but I guess I wanted to cover everything so that your answer is completely answered.
Yeah, sure. So we can say that we are very confident that we will achieve our target of 50% growth in implant segment.
Absolutely.
Yeah.
Absolutely. Without a doubt.
That's great. My second question is, as you have mentioned in press release that we have got in order from Indonesia. So can I know the size of that order?
It's around 100,000 plus. We expect to finish this year, if everything goes right, between 350,000 to $500,000 of sales in Indonesia. So the first order came at around 100,000 plus.
Okay. And I have one more question. That as I saw that there is a sudden growth in OPD, IPD, and surgeries. So can you segregate between growth from SOC and growth from normal hospital segment, if possible?
I'll give it to, I think, Shania or Dr. Nishita or Parag, whoever would like to answer this.
So, as we've already mentioned, SOC, we have a very limited number of surgery. Out of 8,000 plus surgery, what we have done in this quarter, only 154 is related to SOC business. The last quarter SOCs was 107 and quarter one last year was 112.
So on a year-on-year basis, there is a 40% growth in the franchisee business in terms of the number of surgeries that we have conducted. And in terms of the arthroplasty business in the hospitals, the business has grown at 25% on a year-on-year basis in terms of number of surgeries. The other good thing is that our headquarter hospital, which is on SG Highway, has done only 25% of its surgeries. The balance 75% have come from all other units, including Surat, Indore, Jaipur, and so on and so forth.
Okay. I have just one last question. That is, as I saw that home care segment right now is very negligible contribution it have in revenue, but it can have a higher growth potential. So can you give me the vision you have in this segment related to this?
Yeah, so the home care business, we look at it in two parameters. One is the number of patients served, and we also look at the revenue growth. So the revenue growth has been phenomenal in this quarter. We have grown at 71% in this quarter compared to the last year same quarter. And in terms of patients served, we have grown by 30% this year. So we are happy at both the fronts. We provide a lot of services across home care, but predominantly the three biggest services that we kind of give in the home care business is pharmacy, physiotherapy, and diagnostic services.
So how big you are seeing this opportunity in coming years?
Yeah, so we have earlier mentioned that this business can go up to 5% of our hospital top line. So at the moment we would be anywhere between 1.5% to 2%. It has the potential to go up to 5%.
Can you specify the year in next 2 or more?
So the year in which the home care will go to 5% would be very difficult to assume at this point of time, but we would want it to happen over the next 2-3 years on a gradual basis.
Okay, thank you so much. That's all I have.
Thank you. Next question comes from the line of Bhagwat from Prosperity Wealth Management Private Limited. Please go ahead.
Good afternoon, sir. Congrats on the good set of numbers. The ARPOB for the quarter is at 38,000. Could you please update about the sustainability of the same over the upcoming quarters?
Yeah, so I'll start and probably Dr. Nishita or the CFO could add. See, one is that of course our contribution as a specialty of arthroplasty is at about 45% as we speak. So one of the reasons why the ARPOB is also high is because of the arthroplasty patient mix as we speak. Because last year same quarter it was around 41%. So that is one of the biggest reasons why the ARPOB is on the higher side. The other one is we have renegotiated with multiple insurance companies across the board to go for higher rates and the schedule of charges. And we have been successful in many of these. So that is the second major reason why we have been able to achieve these higher ARPOB. So yes, they are definitely sustainable, and there is a conscious effort from the entire team to reduce the dependency on government business. So last year, same time, we were at 25% government business. This year, we are at 22%. So that is another factor why, the ARPOBs are going higher.
Okay, thank you, sir.
Also, we would like to add something.
Yeah, adding to Mr. Shalby, I would just like to tell that we have, got approvals of transplants at 2-3 different units. We have already started doing kidney transplant as well as liver transplant. So that is how the ARPOB is also good, as well as catering more international patients. You see, Q1, we have more patients from Nepal, Bangladesh, and UAE and all, and that is also helping us having more number of high-end surgeries as well as good packages and good ARPOB.
So, ma'am, considering all these factors, so we can assume the ARPOB would be sustainable in upcoming quarters?
Sorry, we were not able to hear you clearly.
So I'm saying, sir, considering all the factors that you have been mentioned, so the ARPOB can be sustainable in upcoming quarters?
Yes. The ARPOB is sustainable at these levels, yes. But again, as I'm saying, they will, they're always subject to changes in the specialty mix.
Okay. Okay, thank you, sir. That was my question.
Thank you. Next question comes from the line of Anup Ramchandra from ANP. Please go ahead.
Hi. You guys are doing exceedingly well in hospital business. Congratulations for that. My concern is with respect to the implant business, more from a strategic point of view. I know promoters have a good know-how as to how to run hospital business. But this investment in this implant business is, from my perspective, it looks a bit risky. Though we've got a good person in Shobhan Das Gupta to run this business. My concern is, what if we don't have Shobhan Das Gupta? Will you be able to run it as good as it is running now?
Great question. So first of all, is that your question or anything more?
Yeah, I have a follow-up question to it. The thing is,
let me answer this first and then.
Yeah.
Okay, go ahead. I'll hear you out and then I'll answer.
Yeah, the reason why I'm asking this implant business, out of many calls, what I've heard, it looks like it's a capital-intensive business, and we need to build a lot of inventory. And there are mainly 4 or 5 big players all over the world. And we are getting into this business where our management does not have much know-how. So this is something which is bothering us from a strategic point of view.
Okay, again, thank you for the question. It's a great question. So I think that's, we have not received this question earlier, so I'll be loving to try and answer this question. First of all, I know you know my background. So I have been running the Asia Pacific orthopedic implant business for Johnson & Johnson. And we were number 2 in Asia Pacific. We made it number 1 and beat Zimmer Biomet in 2 years' time since I took over. So obviously I have that experience of running an orthopedic business. And I ran the India business, I ran the Australia business of implants as well. Secondly, when you look at the people that we have recruited to run the business, we have the gentleman called Garrett Keasley, who is now our CEO and global and president of Shalby Advanced Technologies based in the US, and he reports directly to me. So he has close to 25 years of experience in orthopedics and in medical devices as well as in startups. His last job was in orthopedics in Smith & Nephew in senior leadership position in the US. So Smith & Nephew, as you know, is one of the top 4 companies in orthopedics in the world. He has also worked for Johnson & Johnson earlier. So he's taken over the business since the last 6 months, and he's doing wonderfully well, bringing in a very growth-oriented and mindset and culture in that company. We also have taken in some very good experienced people. We have bolstered our sales team. So we recently recruited one more person in the central area in the US. That would help us to accelerate our growth in sales, and we are getting one more person, an experienced orthopedic business director in the West and one more in the East. So we are bolstering our sales and marketing team in the US so that our reach can be going. And we are getting experienced people and management people who have lots and lots of experience in not only turning around businesses, but accelerating growth. Areas that we are focusing also are India and Indonesia and Southeast Asia. And then later on, we'll get into Africa and Latin America as well. So in India, we have our ex-sales director who used to run a large part of 2 regions in India for Johnson & Johnson orthopedic hip and knee implant. He's the head of our business. And we have close to 14 people now who have recruited from different parts in India who have all worked in orthopedic joint businesses. And they are running the show along with me for the India business. So you can understand we have one of the strongest teams in India like we want to have in the US. In Southeast Asia, we appointed the regional director who was responsible for our Indonesia and Malaysia business earlier for Johnson & Johnson Orthopedics into this fold. So we'll see some magic happening in Southeast Asia pretty soon. And we are covering Latin America. So to your first question, the management of Shalby implants business, I believe, is in very, very good hands. You could not have a better, strong team than what we have. So we are confident that this team will be able to deliver. Now to your follow-up question, yes, it's an investment business. But the good news is that the investments have happened upfront. We have now sufficient inventory, and we have taken some very good steps to ensure that we would be able to get into a very good profitability mode. So what we are saying now is we'll be getting into a mid-single digit EBITDA margin in full year 24. And this will happen due to some launch of very new product launches, much better supply chain situation. And very importantly, we are getting our lower cost of goods sold. So our supply chain team in the US, and by the way, we have one of the very, very highly regarded supply chain person and one of the very highly regarded quality and regulatory person based in the US who's working for us. So the supply chain team are constantly in search of partnering with many quality suppliers around the world who are ready to supply us at lower costs for guaranteed large volumes. And we are looking at large volumes consistently without interruption in supplies. A lot of things have happened because of interruption in supplies in the past. And we are seeing some very healthy savings with procurement of our raw material costs, and we expect further reduction to play in the coming months. So we are in a continuously improved journey, looking at incremental manufacturing efficiencies in our plant by adding many fixtures, rescheduling machines, maximizing efficiency, enhancing productivity. And finally, we have also done a lot of work in negotiating lower cost on freights, optimizing and hiring functional areas, adding headcount, as I said, primarily in sales, and all not only in sales, also in engineering, because this business, this industry fuels our new product launches, and engineering and R&D plays a key role. We already have 2 people. We have recruited 2 more people in engineering. We have an engineering team in India, in back office, under Shalby, who's helping it. All this will accelerate our business growth, bring down our costs. We're already doing some smart negotiation in some of the operational areas in the insurance and daily running costs as well. All this really gives us that this investment that we have made over the last 2.5 years is now coming to fruition. We'll be getting into profitability mode going forward from this year onwards. And then in the coming years, you'll see SAP profitability will soar along with the business growth that we are talking about 100 million in 5 years' time. I hope I've answered your question. Again, it's a long drawn answer, but I wanted to cover everything so that I clear all your doubts in your mind.
See, the doubt is definitely not in the way in which you are running your implant business. The doubt is with respect to what if we don't have you, because the business should be such that it should be able to run even if we don't have to shove in Shalby. Right? That's the
right. So what you are now. Yeah, what you're saying basically is the processes of the system. So even if we used to call it J&J, if I'm run over by a bus in tomorrow, what will happen? So
yeah, because what I see is,
and thank you for that.
Yeah, because what I see is in the implant business, I see hardly 4 or 5 players dominating the market all over the world.
Correct.
Yeah, I'll also add, I think, thank you, Mr. Dasgupta, I think, and I'd like to also add a perspective here. One is, of course, the opportunity that we have in hand. I know that is not the question, but it's very important, for me to address this, that for any company to kind of set up implant manufacturing, get the designs approved, get a US FDA, is a 5 to 7 year process. We have been able to acquire it at a very, very minimal price. In fact, we have paid a fraction of the value of the assets of this company. So at the moment we acquired it, the assets were valued at about $20 million. And this is not including the intangibles. The intangibles were valued at higher, and we paid about $11.5 million for it. So it was a great deal. Having said that, yes, there is able leadership across all levels in the system. And, we have retained a lot of the senior staff that, was part of the growth story over the last 25 years at the erstwhile Consensus. And yes, we have brought fresh talent and fresh mindset at California as well. As what Mr. Shubham said, in terms of Garrett Keesley and his entire leadership team there, who have a lot of background of the implant business. So that is the way we would like to professionally run this business. I hope we answered your question.
So, Shanai,
one more point. I think it's
Yeah, go ahead.
Sorry, one more point. I'll just put it in. And I think it's difficult to share here. I'd love to really talk to you through in terms of the strategic roadmap that we based. So we have created a strategic roadmap for 5 years, which covers every process. So be it the manufacturing, be it sales and marketing, be it engineering, be it quality. We have a roadmap for 5 years. Very meticulously drafted roadmap, which has been led by me through my experience. And that's a process map that has been completely there. So we know exactly that even if I am not there or some senior person is not there, that process will continue. And I think that's where we are giving predominance with the experience that's coming in. The process rules over people in the future. And with the investments coming in, we are creating a machinery going forward that SAP will rule. And to your point, yes, with 4 companies that rule, have taken around 80-85% of the market share. Perfectly fair. But the 15% market that we have of the total $18 billion of the hip and knee market in the US and another around 12 or $13 billion worth of market outside of the US is the place that we would like to play while we nibble some of the shares. And to be honest, if you speak to many of our customers, you'll realize today that those 4 players who have dominated that share is in threat because the way they are being supplying, the way they are being catering to, even if you ask Dr. Vikram Shah and the other surgeon in Shalby, they'll be able to say the service level of the 4 big players are coming down and their focus is going into some other places, including robotic surgery. And that's where we feel our opportunity is to be able to nibble that share as well as take care of the 15% market, which is up for grabs. And that's where Shalby Advanced Technology will slowly get into the picture.
Okay. Shanai, the real concern actually comes from the downside, what we see from, it's always a downside in implant business. See, I'll give you one reason. There's no offense to anyone. See, I'll give you one perspective here. We've been addressing a lot of investors' calls so far. Can you give a reason in any of the calls that you've not done well in this quarter because doctors were on vacation? There's no way you can answer this, right? Because when we get to hear that why we're not done well in implant business, it's because doctors were in vacation in US. It's like difficult for us to comprehend.
Yeah, so I think Mr. Dasgupta,
that was one of the reasons, I would say. I think I said at least 6 or 7 reasons. Basically, I think I started with the doctors being in the holidays and in vacation. That is one of the reasons. There are several, 5 or 6 reasons I talked about, which was tax instrumentation, the ambition knee that was launched, not launched. These are some of the key reasons that highlighted. Because I came in first, that does not necessarily mean that predominantly that was one single reason. There were 5 or 6 reasons behind the software. And as I said earlier, we had anticipated, not that it came as a surprise to us. That reason, if you see, my business plan is in terms of quarter by quarter is 10%, 16%, 31%, and 42%. And we have the plan in place. It's not that we were surprised by the soft performance of this quarter. We were anticipating that this will be coming because we came to know in January or February of this year that the instruments thing is getting delayed, that the designer surgeon is asking for a different simple instrumentation which will take time to get in. It will take time to convert the disposable instruments design into a reusable instrument design to a manufacturer vendor. We came to know. So we baked in our plans. So when I look at the plan versus performance, it's not very far away from the plan versus the performance. But yes, when you look at from a year-to-year comparison and versus what the quarter-to-quarter comparison, it looks bad.
Thank you. Mr. Ramchandran, we request that you return to the question queue for follow-up questions. Next question comes from the line of Heath Wan from Elara Capital. Please go ahead.
Congratulations, sir, for a good set of Q1 numbers. I would like to know about the capex plan for like FY24 and 25. If you could just elaborate. Thank you.
Yeah, I think I can start with the operational capex and all the new capex. I think Parag can kind of throw some light on that. So, in the first quarter, we have done about 4 crores of operational capex, which is largely half and half. Half is really kind of replacement capex, and the other half is new capex. So we expect that number to be between 16 to 20 crores in this year. In terms of new capex, Parag will be able to throw some light.
I think for the new capex will go into certain SOC launches. The FOSO launch, like we have talked about, Rajkot being made operational in the year. So, somewhere in the range of 5 to 7 CR towards one unit of SOC being operationalized on the FOSO model. Other than that, there are new hospitals which are in Anvil, and the capex will go towards operationalizing those at Nasik, which we track, towards this year and early next year, operationalizing that, plus any new other units which may come through.
Thanks, sir. Secondly, I would like to know about the tax rate. Like, what is the tax rate we are envisaging for FY24 and 25?
Yeah, so I think Mr. Amit Pathak will be happy to elaborate, but we are still falling under MAT, the minimum alternate tax, and we pay a little over 17% in terms of cash tax. However, the books you will see that the numbers will be different, but the cash outflow is only 17% as we speak.
Yeah, yes, Shanai. So this is correct. We are falling under the MAT, and we still have the leverage of lower taxation, and this year we continue at the MAT also.
Thank you, sir.
Thank you. Next question comes from the line of Rikesh Parikh from Rockford Capital LLP. Please go ahead.
Yeah, thanks for the opportunity and congratulations on set of number, especially on improving the ROC to 16.6 on a consolidated basis. First question is, can you just briefly update on the Ashabarak and Nasik hospital on the expansion side?
So, yeah. For the Nashik, as I just talked about, we are looking forward to operationalizing it over this year and Q1 next year. Still, what we talked about in the last call, waiting for our builder to hand over the premises. That there are certain challenges which we are working together with the builder to overcome. For Mumbai, we are still to start work, and I think over the next 3 to 4 years is where we look at operationalizing the place.
But have we got that requisite approach from the NGO and the BMC which we are waiting for?
No, didn't get you there. Please, if you could come.
Have we got the approval from the Charity Commissioner and the BMC which we were waiting for the starting of the project?
So those approvals are still, awaited. Those are applied for, but they are still awaited. So once they are done, then what we look forward to is building up the place. So yeah, but things work in parallel. They are not sequential. So as we wait for those approvals, the work on the BMC approvals and other things, design etc. is in place.
Second is on the EBITDA side this year.
Sorry, not able to hear you very clearly. If you could,
Inside, we have been able to do 23% margin. Is it sustainable as on a full basis as such?
Moderator, we are not able to hear it clearly. Rikesh, your lines are not clear.
Yeah, now it's clear.
It's again small break. Okay, fine.
Scratchy, but again you can try and we will try and listen if I answer it.
Sure. On the EBITDA, this quarter we did 23% EBITDA margin on a share basis. So on a sustainable basis for the full year, if you sustain and where we are looking at it going forward.
Yeah, so I think if you're asking about the EBITDA margin for the hospitals business, yes, it has been at 23%, and there will be a margin expansion, in the coming quarters. Because the revenue is likely to go up. We have invested in this quarter also across building a lot of capabilities, as Dr. Nishita said, with regards to other specialties, right? So that is going to happen. On a like-to-like basis, we have invested 100 basis points more in this quarter compared to last year, same quarter, on the marketing expenditure also on the business and promotion. So like-to-like basis, we are much better off. It's just that we have reinvested a little more, but we've been able to still manage, the same EBITDA margins in the hospitals.
And last, on the SOP side, means operational state, so by the end of the year, how many SOC we are looking at for 24?
So for FY24, by end of the year, we are looking forward to, currently we have 4 operational. We are looking at somewhere around 8 to 9 operational units by end of the year.
Okay. Thank you. That's it from my side.
Thank you. Next question comes from the line of Divya Daga from Vijit Global Securities Private Limited. Please go ahead.
Hi, sir. I have question related to home care again. I want to know the charging model for the home care. How do we charge it? How is the revenue model like it?
For the home care, if you see, we have like 5-6 different services. So it is a consultation, attendant at home, nurse at home, pharmacy and diagnostics, and then an ICU setup at home. So usually, our collection and, all are free charges. Our drop and pickups are all free, but the charges are as per market rate and which lesser than what are the hospital rates, what we charge, comparative to other competitors with us.
So can you give me the average of what we charge?
So what do you mean when you say average? I'm sorry.
Average revenue we charge per patient in home care.
It really depends on the services, that has been asked for. So if it's a physiotherapy service, the charges would be very different on an average per patient. Vis-a-vis somebody who's just ordering medicines, it would be much higher for somebody who wants a doctor on call. So it would really depend.
Okay. So can I know what geographies we are catering right now in home care?
At present, it is, the places where we have a hospital, so that we have backup related to all services what we are giving to the patient. And we have also started catering, calls from metros, Delhi, Mumbai and all. So till from this quarter, we will be expanding to our SOC places also. Where we are coming up with our SOC, we will be giving home care services to that patient also.
Okay, so are we expecting franchisee model in this segment as well in near future, maybe?
No.
Okay, thank you so much. I had this question.
Thank you. Next question comes from the line of Ashka Trivedi from KDA Securities Private Limited. Please go ahead.
Am I audible, sir?
Yes, you are.
Hello? Yes, sir. So I just wanted to understand that at the inception of the call, you stated that Ambition knee market is going to be a game changer for India. So I just wanted to know in what context it will be a game changer.
Yeah, thank you for the question. The reason I say it's a game changer is basically when you look at the overall market, the organized market in India, 85 to 90% of the market is knees or total knees and unicompartmental knees, total knee and compartmental knees. Today, if you see what we have launched in India is mainly the unicompartmental knee and our hips and our cups. We also have launched our CKS knee, but our CKS knee is more of a cruciate retaining knee. The Indian market is more of a posterior stabilized knee or PCL sacrificing knee as we call it. So because we do not have a CKS knee, which is predominantly a PS or a PCL sacrificing knee at this moment so much in terms of our supplies, we expect that when Ambition comes, which is a very modern design, this would be a blockbuster in the future. And we have already been able to talk to some people on Ambition, and we are seeing a lot of responses of being Ambition coming in. And not only will be giving Ambition in the current version of the product that you see, that is the Cobalt Chrome version, we'll also be able to give the tin bin coating. Tin bin coating is basically a coating which gives a gold color to the knee. It's a titanium niobium nitride coating, which is basically given for patients who have a nickel sensitivity. And that's what we are going to bring Ambition. And that's the reason I'm saying Ambition will be a game changer. It will be used in Shalby hospitals. It will be used a lot outside of Shalby hospitals in India as well.
So, sir, is this kind of knee already available in India and overseas, or is this for the first time, at least in India, we are launching this kind of knee?
No, Ambition knee was a knee that was designed before we took this company. It is a very modern design knee. It was already 510K approved. So when we took over this company called Consensus Orthopedics, Ambition knee was already 510K approved or FDA approved. However, as I said, the instruments that were there were done for disposable instruments. So we had to change it to the reusable instruments, get the designer surgeons involved, and it took a bit of time. So yes, the Ambition knee has still not been manufactured. It will be manufactured in the coming months, and then we will be able to launch. So it is nowhere it has been launched yet as of now. So we are still in the manufacturing process of Ambition.
And sir, any revenue guidance annually for the implant segment?
So we expect a 50% plus growth in the revenue side of things for the full year 23-24. And we expect to scale it up to $100 million over the next 5 years' time. So we expect a 55%, 45% split between US and OUS. The US market, the average selling price is almost 2.5 times more than the OUS market, which is India and some of the Southeast Asian markets. And that's the reason when we look at the volumes, volumes will be much higher in the OUS market, including India, versus the US market, where we will get considerable 2.5x prices than the other markets. So to your question, the revenue guidance will be 50% plus this year in terms of our top line, and will be $100 million in 5 years' time.
And so one last question, that in order to achieve $100 million of revenue, what capex we would be expecting in next 3 to 5 years in the implant segment?
Yeah, the main capex that will be coming in is for the instrumentation. So as you understand that every knee or a hip that is put up, you need to manufacture instrumentation. So the main capex that will be coming is for instrumentation. And obviously there is recurring expenses that happen in the manufacturing side of things in our plant. As I said, we have a strategy in place that we have been able to understand how do we balance our manufacturing strategy. Everything that we are manufacturing, or rather everything that we'll be producing in that $100 million business will not be manufactured in our El Dorado Hills plant. We have been able to identify a lot of FDA-approved high-quality vendors who will be able to supply several parts of our products to us to finally sterilize and do our quality aspects from various parts of the world. And because we'll be a substantial volume company going forward, we have been able to negotiate some excellent prices. So on the one side, we'll be able to reach our $100 million by selling large volumes, both in US and outside the US, as well as through our balanced manufacturing strategy, we'll be able to bring in down our cost of goods in a very significant way so that we become a highly profitable company when we reach that 5 years time period, as I said earlier.
That's it from my side, sir. Thank you so much.
Thank you. Other questions? Hello?
Yeah. So operator line has dropped actually. He'll be reconnecting.
Oh, that's what I thought.
Yeah.
Hello?
Yes.
Yeah. Am I audible, sir?
Yes, you are.
Yeah. So with regards to capex, I would like to know that what is the amount which you are going to incur on the Nashik and Mumbai project? Like,
See, the Mumbai projects at a total level will be somewhere in the range of 150 to 200 over a next 3 to 4 year period, where large amount of it is going to be in equipment and something which is to be invested towards the end of the project. Nashik, given that it's a built-up area and we are getting the warm shell there, the investments will be in the range of 50 to 70.
okay. And so with regards to MET, so are we planning to utilize it fully till FY24 or like it will be stretched a bit?
It will stretch a bit.
Okay, so till FY25 year end or like H2 or H1, like what is your estimate?
By H1.
Only by H1. Okay. And so, and so with regards to beds, I would like to know that what is the type of bed addition we are going to see in the next 2 to 3 years? Like, what's your plan according to?
So I think as Parag said, the bed addition will be 300 plus beds that will come in Bombay and Nashik put together. And over and above that, there will be an expansion of beds in terms of our operational beds, which are today at 1,350, will go up to 2,000 as the occupancy ramps up. The third one will be, all the potential franchisee opportunities that we are evaluating. As and when they fructify, they will add to the number of bed capacity, whether operated or managed by us, depending on FOSO and FOSO.
Okay. Thank you, sir. That's it from my side.
Thank you. Next question comes from the line of Bhagwat from Prosperity Wealth Management Private Limited. Please go ahead.
Hello, sir. So I would like to understand about the raw material for implant business segment. Where do you source from those? Could you please give some color on that?
Yeah, so basically when you look at the raw materials, there are very different types of raw materials that come in. So for example, you get the forgings. Forgings happen for titanium. So all the titanium products that come through forgings. And that comes from vendors both in the US as well as outside the US that comes in. For the hip side of things, the acetabular side, we get titanium products and then we manufacture within our factory, but we will also get forgings in the future from our vendors. Then when you look at the knee product, it's basically castings because it's cobalt chrome. You cannot forge, so you have to cast them. So you cast those, and that comes again from various vendors, including vendors in Germany, including vendors in the US that we get in. Also, we get our instruments manufactured both in-house as well as from vendors in the US as well. Plus, the plastics, as we call the vitamin E plastics, comes from a very renowned company in the UK, and they supply almost close to 90% of the entire plastics. Finally, the ceramics come from a company again in Europe, and they supply close to 97% of the ceramics that is used in. So these are the raw materials that come out: cobalt, chrome, titanium, stainless steel, ceramics, as well as vitamin E, polyethylene that comes out.
Okay. Thank you, sir.
Welcome.
Thank you. Ladies and gentlemen, due to time constraints, we have reached the end of question and answer session. I would now like to hand the conference over to management for closing comments.
Thank you very much. I think it has been a great meeting. We love the questions, and as you have seen, there has been some stupendous performance in the first quarter, especially driven by our flagship business, our hospital business. And we have also contributed a bit from our other businesses, including the home care, the SOCE, and our implant business. As I said earlier, that our outlook for the future quarters look very bright, both in the hospital business as well as in the other segments, which have lagged behind a bit in the first quarter, which will be coming up. So we expect that, again, there will be a fantastic performance, both at the top line as well as bottom line level going forward. So thank you for all the questions. If you have any further questions, please email to us, and we'll take the endeavor to answer you and get you back. Have a great evening, ladies and gentlemen. Thank you.
Thank you, everyone.
Thank you. On behalf of Elara Securities India Private Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.